this is Charlie ETM, the founder and CEO of GuruFocus. Thank you for visiting us. In this video, I want to show you the market valuation related pages on GuruFocus.com. We actually have two kinds of these pages, and I will show you both of them in separate videos. And as value investors, we don't try to predict where market will be in the future, but we want to know where the market is, where market stands at any point. And that's where the Buffett indicator comes into play. As Warren Buffett said, this is the single best indicator of the market where we are to himself. And let me share my screen with you. Okay. This is a Buffett indicator, and it is under the market tab here, and number 5 is Buffett indicator, and number 6 is global market valuation, which is actually the Buffett indicator for the global market. And in this video, I'll cover both of them. We have separately Shiller P and Shiller P by sectors. I will do that in a different video. Okay, so what is Buffett indicator? Buffett indicator is actually a very simple ratio. The ratio is the total market cap divided by the GNP. GNP is gross national product. And this ratio, as Warren Buffett said, it's probably the best single measure of where valuation stands at any given moment. That's what he said from this sentence. I quote him. So let's look at the numbers here. If you look at the chart, first chart here, this is the US total market cap. Together, we use Wilshire total market cap index. Currently, it's about 42.9 trillion. And this green line is the US GDP. And we use GDP instead of GNP because GDP updates quicker. And the numbers actually are very close, within 1%, the GDP and GNP. So which one you use doesn't affect the calculation, doesn't affect the conclusion. And as Warren Buffett said, the ratio of these two numbers, the ratio of these two numbers is the green line here on the second chart, which is the total market cap divided by GDP. And currently, it stands at 172%, about 172%, which is actually, if we look at the longer term, and the green line here, and it has never been this high. It has never been this high. Actually, in year 2000, it was a peak, but it was not nearly as high as it is today. Actually, as it was actually last year, and now we come back some, we recovered some, but still much higher than any time except the pandemic peak in 2021. And okay, that's actually the original Buffett indicator, and we made some modifications to it. We want to consider the Federal Reserve balance sheet as well. Because historically, in the past, the balance sheet of the Federal Reserve was a much smaller number than the GDP. And if you look at here, before year 2007, before the financial crisis, the balance sheet of this red line actually here, the red line here, the balance sheet of the Federal Reserve was less than 1 trillion, and we have the GDP was more than 14 trillion. So GDP was much higher than the balance sheet. But then the Federal Reserve started to print money for the financial crisis, and it printed even more during the pandemic. Now it's above close to $9 trillion for the balance sheet of Federal Reserve. And the GDP stands close to 25 trillion. So the Federal Reserve balance sheet is a considerably important number relative to the GDP now. Obviously, when Fed prints money, the stock market goes up, even if the GDP doesn't change. So that's why we want to put the Federal Reserve factor into the valuation. we add the GDP and the Federal Reserve balance sheet assets together as a denominator to calculate this ratio. And I think that it gives us a better indication of where the market valuation is, which is actually this blue line here in the second curve. If I remove this green line, you can see that the blue line, I think it gives us a better picture of where the market valuation is. If you look at the blue line during the pandemic peak, it's higher than the 2000 peak, but not as high as it showed in the green curve there. And as of currently, this ratio is still very high. It's about here 127%, but it is lower than the peak during the dot-com bubble. So from this ratio, and we can assume that it will revert to the mean over time. We can estimate where the market will return over time. And actually, if we look at here, if we are we have three kind of scenarios here: the red one, the blue one curve, and the green curve. So the red curve is if we are extremely optimistic, where the market return will be. And the blue line is if we are neutral, not that optimistic, not that pessimistic, where the market will be, future return will be. And the green line is if we are kind of pessimistic, where the market return will be. And this actually, there's also a yellow curve here. Yellow curve is the actual return of the market. All the returns here are the 8-year normalized annualized return. And we're assuming the ratio will revert to the mean in 8 years. That's why the actual returns, the latest number is from 8 years ago in 2014. So as of current, if we are very optimistic, we can see that the return is about 3%. Future market return will be about 3% a year. And during the peak of last year, 2021, June 2021, the market will give very low returns, even if we are very extremely optimistic, about 0.5%. And if we're neutral, last year during the market peak, we were predicting that the future market will be negative returns, negative 2.6%. If we're pessimistic, is this green curve here, the market would return about negative 6.6% a year, and in the next 8 years. So depending on if you're optimistic and pessimistic, and I think it's also affected. This curve also affected by the future interest rate. You can see that in the past, this green curve and the yellow curve actually works really well before 2010, 2008. They overlap extremely well. But then after 2009, 2010, the Federal Reserve placed more and more important rules and adjusted the interest rate, which affect this line. And it distorts the market. But at today's valuation, even if you are very optimistic for the future, the return will still be small, very small for the next 8 years. Unfortunately, that's where we are. This is actually the case when we don't consider Federal Reserve balance sheet. And if we consider Federal Reserve balance sheet, the situation is, I would say it's better. It's slightly better. But currently, if we are optimistic, it will give a slightly better 3.6% of returns. If we're pessimistic, it will give negative 2.7% returns. Okay, this is a Buffett indicator for the U.S. market, and we update it daily. Currently, as of yesterday, actually, market is significantly overvalued still because the ratio is extremely high still, 172.5%. In the neutral case, it gives almost no return for the future, including dividends. And basically, we're predicting the index would be flat for the next 8 years, actually negative for the next 8 years still. And yeah, that's the case when we don't consider the balance sheet of the Federal Reserve. When we consider it's slightly better, we are predicting 1.5% of return in the future, but that includes dividends as well. In this case, the index will be about flat for the next 8 years. That's where we are for the market data. And now, if we look at the global market, and if we go to the next manual, global market valuation, we come here, we cover all these countries here, including developed countries and the emerging market. The principle of doing this is actually the same. If we look at the best country with the best perspective market, and Singapore, this is Singapore GDP, this is a Singapore total market cap. That's a ratio. Okay, that's the asset of Singapore's central bank. And here, this green line again is a ratio of total market cap over GDP without considering the total assets of the central bank of Singapore. And this blue line it does include the central bank contribution. And yeah, then we predict the market, assuming in 8 years it will revert to the mean, and the return is about here. The two scenarios, the green curve and the blue curve with the central bank consideration. And in Singapore's case, they're both predicting double digits future market. So seems like Singapore is a better place to invest according to this valuation. And historically, for Singapore, the actual predicted return was this red line, and the trend is similar to our prediction, but it's lower after 2010. Before 2010, the two curve actually works pretty well, but after 2010, the curve is the shape is the same, but it's lower by about 5%. Assuming it's lower by 5% for next 8 years, but it will still be much better than the US market. Seems like, yeah, that's a global Buffett indicator. Again, whenever you have questions, please come here, come to support, visit us, and chat support. We can do a chat. You can create a ticket. You can schedule a meeting with us, one-on-one meeting with us. You can also visit us, actually visit us physically in our office, in Plano, Texas office. I will personally meet you. Okay, that's the Buffett indicator page. Again, it's under the market tab, Buffett indicator and global market valuation. And if you have questions, please feel free to create a ticket or chat with us online. And we're very glad to help. Thank you very much.